So here's some rates around the traps. 10%'s a nice margin that most countries have, and the years that they've been introduced. I understand with Singapore that the registration threshold for Singapore when they brought in GST was $1 million Singapore dollars. So they have put the threshold very high to reduce the number of people in the net. And that's the way they want to work it in their particular area. Okay, there's only a few countries in this area and a few countries in the world who don't have a GST or a VAT. One country in the world that is the largest country basically in the world from a production perspective, the USA, does not have a VAT or a GST. That's because I think it'll be too difficult with 50 different states to get agreement as to what we've got to do, because generally GST or a VAT involves some taxes disappearing, being abolished, and they are usually state taxes, state revenue. So most states are reluctant to give up that money unless there's something in it for them. Okay? Everybody all right? Thanks for volunteering your Saturday morning to listen about tax. I know it's not the most enthralling of subjects, but anyway, we'll see how we go. Now, some basics of GST. Pretty simple. You make a taxable supply by a person who is registered in the course or furtherance of a business in Malaysia. Okay, so the second line there, by a taxable person. If you don't register and you've breached the threshold, so you should have registered, customers will probably still visit you and ask you for some money. All right, so if you think your option is, I won't register and they'll never find me, think again, because they will. All right, this is the easiest tax in the world from an auditor's perspective, which is why governments love it. All right, it's easy to make money with GST. Now, the basics we talked about before. If you're in business, you're purchasing goods as inputs to your business. You then produce something, goods or services, and those are your outputs, okay? So terms for GST, inputs, input tax. Outputs, output tax. So classically what happens is that you work out how much tax have I paid or am I liable for my inputs, how much tax do I owe for my outputs. The difference between the two is what you've got to send to customs. Now the issue with this is that from an input tax perspective, I can claim my input tax, so on my purchases, when I have a document called a tax invoice. So I don't have to have paid my supplier. I can still get the credit. Conversely, on the output tax side, as soon as you issue a tax invoice, you have a liability for GST. So that if I'm your customer and I don't pay you for 60 days, well, unfortunately, customs will still expect you to pay that GST. So it's a balancing act with cash flow. You have the advantage on the input side of only needing a document called a tax invoice. On the output tax side, as soon as you issue that document, your liability crystallises. You owe money. All right? And this is the system throughout the world. The revenue authorities love this system. Okay? They're getting their money whether you've been paid or not, or when you get paid. Okay? In a situation where you're getting a refund from the revenue authorities, customs, expect them to ring you. If not, call you personally. In Australia, one of the prime audit triggers is if you're getting a refund. So revenue authorities throughout the world do not like giving people money back. All right, so they usually question it. In Australia, we have huge mining companies who dig coal out of the ground and export it all over the world. They are a #1 audit target for the Australian Taxation Office because they're getting money back. All right, classically, they have to get money back. Their outputs are all exported. All right, so when you export goods or services out of Malaysia, they are 0 rated, so no GST. All right, so you're taxing domestic consumption. The advantage that a GST or VAT has over sales and services tax is that the tax does not stick to export transactions, so it should make you more competitive in the international market. So that's why it is an advantage for export industries. Okay, this is basically how it works. So a manufacturer claims any input tax credits he has, he charges to a wholesale merchant. The wholesale merchant claims the input tax credit for the sale from the manufacturer. He then sells on to the retailer. The retailer claims back what he paid to the wholesaler. And the retailer sells to the end consumer who pays the GST and can't get it back. All right? So you and I as end consumers pay the tax and can't get them back, and that is the way it works in every country of the world. So we've got a simple example here, and this is probably one of the best ways to explain why GST does not stick in transactions. So what we're simply showing here is that a manufacturer sells to a wholesaler, sells to a retailer, who then sells to the end user. Now, all along the chain here, the business entities are charging GST and claiming back what they paid on their inputs. So they're only being taxed on their value add to that transaction. All right? And at the end of the day, you and I as the end consumer, we pay the GST, we can't get it back. All right? So with GST, which works efficiently, the input tax, the GST should never stick to the transaction for the business parties. You will always get it back. All right? It's an important message to take away. I've got some slides later on sales tax. I'll show you how it in fact does stick to transactions. Okay, now this is an important part of the GST understanding, because what you are trying to work out is, am I making a supply? And if I'm making a supply, where am I making it? When am I making it? And for how much am I making it? And do I have to charge tax or not? A simple example here, if you had a business in Langkawi and you are selling goods similar to someone in KL, you may find that in Langkawi there is no GST. There are 3 areas in Malaysia which have been removed from the GST net, which is Langkawi, Tiamen and Labuan. Okay? So you're in mainland Malaysia, shall we say, you're in the GST net. When do I actually make the supply to someone? Because one of the things you've got to do is prepare a GST return. And in preparing a GST return, you've got to put the transactions in the right month for your output tax, the money you owe customs. All right? You put it in the wrong month, they will come to visit you. All right? So you need to know, when am I got to send this money to customs? And there's 3 basic points. Is if you get paid, you owe the money to customs. If you issue a tax invoice, you owe the money to customs. And there is also another special rule on goods which are delivered or services performed, which we won't go into today, but it also complicates matters. So it's basically, though, if I've got paid, if I've sent someone a tax invoice, I've got a liability. I've got to think about whether it's this month or next month. The value. In any economy, a lot of transactions are done by barter, by contra. All right? When I pay you 100 ringgit for a transaction in cash, very easy to work out. What if we swap? I'll do something for you and you do something for me. From a GST perspective, on the basis that the transactions are taxable, we are required to include them in a GST return. The easiest thing to miss are contra transactions, because in a lot of cases, or in most cases, they never appear in the accounts. All right? Nobody issues a tax invoice or an invoice or anything for a contra. It's usually done by phone, by email, by letter, whatever else. It doesn't usually appear in the accounts. So for GST purposes, they need to be there. So you need to know, what am I paying on? So I charge you 100 ringgit. In that 100 ringgit is the GST. If I charge you 106 ringgit, so 100 plus 6%, you've passed the GST on to me. So it is important to work out your pricing. If you maintain your present pricing levels and the GST is included, does my margin that I previously have remain? If so, there isn't an issue. If not, then you've got to think about, do I have to adjust my pricing? And we'll talk about pricing in a moment. Okay, I've mentioned a few of the rates. Now, standard rate's pretty easy. That's 6%. All right, so Australia, standard rate 10%. In Malaysia, 6%. The bonus of being a standard rated supplier is that whilst I have to charge people for what I supply, I can claim back my input tax credits. So pretty good place to be, all right? Zero rated supplier, that's possibly the best place to be. When I provide my goods and services to someone, I charge GST at zero. All right? I can claim back all my input tax credits. So I'm always in credit with the revenue authorities. Problem with that is that they will get to know you very well. All right? They'd want to see you. Now, an exempt supply. An exempt supply means I'm not required and are precluded by law from charging GST on what I do. You cannot charge GST. But I cannot claim on my inputs now. So my costs have gone up by 6%. Now I either absorb that additional cost or I pass it on in some form of higher pricing. I cannot pass it on as GST. And the last one there is out of scope, no GST. I'll talk about a couple of those transactions which typically happen in any country. What it basically means is that you're not required to charge GST and not legally allowed to, and also you cannot get your input tax credits back. So again, not a good place to be. So if we want to look at standard rated, all right, so some of the things that are standard rated, land for commercial purposes, administration, industrial purposes, and construction. All construction is +6. All right, so we'll talk about an exempt supply soon. So if I'm a construction company, I have to charge GST to my customer, regardless of what they can or can't do with the GST I charge them. My responsibility, my legal requirements. Okay? So standard rated, 6. Zero rated, good place to be, all right? I charge 0, I get all my inputs back. Now, there is a draft list of zero rated supplies on the Customs website. It's basically the list that was in the Prime Minister's speech from the budget on 25 October 13. All right, it has not been confirmed. That hopefully will come out soon. Now, in their export sales, typically every country in the world zero rates export sales. International services, basic foodstuffs. In Australia, we had a sales tax where basic foodstuffs were not subject to sales tax. You have a similar regime here. What they did in Australia was they just transferred all the sales tax provisions straight across into the GST and said if it's sales tax exempt as a basic food item, it's GST zero rated as a basic food item. I don't think they're exactly doing that here. The list that I've seen is a lot shorter than the list of basic foodstuffs. All right, so some things that I would typically think are basic foodstuffs in Australia are not in the draft list that I've seen for Malaysia. Okay, there's also some provisions for water supply and electricity for domestic premises. Okay, water supply and electricity for commercial or business premises, +6. For domestic premises, zero rated, up to a certain limit. I would suggest this will provide electricity and water supply companies with months and months of entertainment trying to work out how to do this, all right? They'll have to classify all their customers first before they can do it.